Hi, everyone. Thanks so much for joining us tonight. I hope everyone's been able to get their video and sound working so you can hear and see us all properly. We really appreciate you guys taking the time out tonight to come along, and we hope that you find something useful out of tonight's presentation. We've developed these In the Know webinar series as a way to kind of keep you up to date and informed on topics that we thought might be relevant to you guys, both personally and professionally. So as I'm sure you're all aware, tonight's presentation is focused on first home buyers and whether 2020 is the year to be purchasing your first home. I'm sure you can all agree that it has been a pretty crazy and unpredictable year. So we'll try and unpack sort of what that means for the property market and what that means potentially for you as first home buyers as well. So my name's Alex. I'm a residential banker with BOQ Specialist in the New South Wales region, joined by my colleague down in the bottom right, Zain, who is a residential banker in the Victorian and Tasmanian region. So Zain will be kicking us off tonight with a presentation around how to get your finance sorted. So Zain will touch on some of the questions that might pop up when you start looking into finance, like things like how much can you actually afford to borrow? Do you need a deposit? And if so, how much? And also touch on, you know, the different types of home loans available and what might be right for yourself. We're also lucky enough to be joined by Julian, Muldoon and Eloss, both from One Group Property Advisory. If you guys want to say hi.
Hi guys.
Yeah. So yeah, Julian and Tal will be running us through some market-wide trends and insights that we're seeing, whether now is potentially a good time to be buying. They'll also touch on a few negotiation tips. So, you know, buying your first home can already be exciting, but can also be quite daunting. And then having to deal with real estate agents and having to attend auctions on top of that can be quite nerve-wracking. So hopefully they'll be able to give you at least a few pointers to get you started if and when the time does come. They'll also touch on a few first home buyer incentives and government stimulus packages that may be available to you as first home buyers as well. At the end of the presentations, we will have time for a Q&A session. So there's a chat function that you should all be able to see on your screens. For those of you on a desktop, it should be to the right of your screen. And for those of you on your mobiles, you should be able to see it underneath the presentation. So if any questions pop up as the guys are presenting, feel free to type them through. You don't have to wait until the end. They are anonymous as well. And then at the end, I'll jump back on and run a bit of a Q&A session with the guys, and hopefully they can answer all the questions that you've asked. So yeah, as I mentioned, Zain will be kicking us off tonight. So Zain is a financial specialist with over 6 years experience dealing with medical, dental and veterinary professionals in the Victorian and Tasmanian regions. Zain has a really good understanding of the medical profession and the career progression that you guys go through, and he enjoys finding sort of tailored banking and finance solutions to suit all stages of your career. Zain also has a particular passion assisting first home buyers. So, you know, guiding them through the process from inquiry, borrowing capacity, through to application, settlement, and getting you the keys to your first home. Julian Muldoon is the director and founding partner of One Group Property Advisory. Hi. Having used a buyer's agent himself in his early investing years, and also studying financial planning, he set out to really change the property, create a business that would change the property advisory space. Julian has success in residential and commercial property acquisitions, as well as a lot of experience in the corporate world. So these were really the foundations for a successful real estate advisory business. Along with Julian, Eloss is also the founding partner of One Group Property Advisory. Tal has a very extensive educational background, having studied in a majority of areas, including law, medical science, financial planning, real estate, and mortgage broking. In 2005, he founded a multifaceted financial planning firm that focused on providing financial solutions to medical professionals and also legal professionals. However, down the track, he did decide to focus purely on the property advisory division of his business, as he found that that was the best, the key to sort of wealth creation for his clients. Together, Tal and Julian have decades of experience in property and real estate investing. So I'm sure they have a wealth of knowledge to provide with us, all of which they will try and sum up in a 15-minute presentation. But I have faith that they will do so. So without further ado, I will hand over to Zain, who will run you through how to start preparing your finances. And I will join you guys again at the end for the Q&A. So don't forget to type through your questions while the guys are presenting. Thanks, Zain.
Thanks, Alex. Everyone, thank you for joining again. My name is Zain, as Alex mentioned, working here in the Melbourne office of BOQ Specialist. I just wanted to take you through, or we'll be taking you through, just a few steps involved in purchasing your first property and how BOQ Specialist can assist you throughout the process. So let me get the slides going. Perfect. So, yeah, sorry. Purchasing your first home will be, for most of you, probably the first or the biggest financial decision you'll make in your life so far. So you want to make sure you've done your research, and hopefully today's presentation will assist with that as well. I understand most of you might be renting, or probably will be looking to move out and deciding either to buy or to rent a property. So here's just a quick slide to start with, just to show the difference between how much you might end up spending if you were to buy compared to if you're renting. So if you were to purchase a property, say valued at $700,000, in most major cities, you're expected to pay around 5% in rental. That's the rental yield of the property. So that works out to be about just a bit over $2,900 a month. Whereas compared to that, with rates being historically low, there's an estimate there at about 2.79%. You'll be expected to pay just a bit over $2,500. So you can see the difference between if you were to purchase and the repayments there compared to if you were to rent the same property or property valued at about the same price there as well. Those repayments on the left side are calculated at 90% LVR loan. So obviously there is a contribution required from your end as well, which we'll talk through. Now, once you decided to purchase a property, and the guys from one group will obviously talk through the trends in the property market as well and why it is a good time to maybe purchase right now, other than obviously the rates being historically low. So once you made that decision, the most important step that you need to take before you actually go out, make any offers, or even possibly before you start looking for properties, is to have a pre-approval in place. It's imperative that you contact your bank before you make any offers. A lot of times we do see people approach their bankers once they've already purchased a property, and in some cases they may not be able to secure the loan that they need to complete that transaction, and that might lead to issues around possibly even losing a deposit in some cases as well. So it's quite important that you contact your bank for a pre-approval before you take that next step and go out and look at properties or attend auctions, even make any offers as well. What that would allow you to do, most importantly, firstly, it'll let you, the bankers will advise on your borrowing capacity, so you'll know exactly how much you can borrow from the bank. You'll also know how much deposit you need to put in. So some banks might require a 10% deposit, plus stamp duty and other costs. Some might require a bit more, up to 20%, some less. So you would want to know, A, how much you can borrow, B, how much you need to contribute, and whether you do have that amount saved or you can source that amount to be able to complete that transaction and purchase your first home. Another thing pre-approval will also let you know, I suppose, or your bankers will, are the borrowing conditions linked to that pre-approval. And what that relates to is sometimes a bank may be willing to lend you a certain amount or the amount that you require. However, there may be a few conditions attached to it as well. And that might include things like maybe close a credit card. You need to provide another payslip or any other item the bank might require you to do before you can secure that finance. So to get all that information, it's quite important that you have that pre-approval in place. And most banks, including BOQS, will offer that for up to 3, and it can be extended for another 3 months as well. So you basically got 6 months. That approval will be valid for 6 months for you to then go out and make an offer and purchase the property as well. Those approvals, by the way, are fee-free and obligation-free at most banks, so there's no charge there as well. Affordability, so the first point from the previous slide, the borrowing capacity, the way that's calculated, or a very broad way to put it, is mainly just using your cash flow, so how much income is coming in and how much is going out to service any debts or any living expenses that you might have. There is a slight misconception out there that your assets might convert to a higher borrowing capacity. So if you've got cash, or if you've got a couple of cars, that might allow you to borrow a bit more. So your assets don't really generally convert or allow you to borrow more. They build a good profile, but it's mainly just the cash flow. So how much income's coming in and how much of it is going out, and your savings, etc. as well. So if you've got, for example, if you've got a good share portfolio, that's not going to allow you to borrow more unless obviously it's generating an income that you can use in your borrowing capacity calculations as well. In terms of the deposit as well, how much deposit you need to put in depends on your personal situation as well as the bank that you're approaching. And most banks will require a 20% deposit plus stamp duty and any other costs that there may be. You can borrow a higher percentage, so you can borrow 90%, or you can in some cases borrow 100%, but most banks will charge you lender's mortgage insurance if you are putting in less than 20% deposit. What lender's mortgage insurance is basically, it's an insurance that the bank takes out to protect itself from the risk of you defaulting on the loan or the loan going bad, in other words. So it's protecting the bank, but it's expecting you to pay for that lender's mortgage insurance because you're taking out a loan with less than 20% deposit. So I think the next slide basically covers that as well. So yeah, it's just a quick example of how much you might be expected to pay. It depends on the bank and the insurance company that they might be using as well. But just a quick example, if you're looking to purchase for around 500,000, and you don't have a full 10% deposit saved, you're only putting in, say, 5%, so you're essentially taking a 95% loan, you'd be expected to pay just shy of $21,000 in lender's mortgage insurance. And all that amount is mainly just to protect the bank from the risk that you might default on the loan. So in other words, how I like to call it, it's basically wasted money for you to spend on LMI or lender's mortgage insurance to protect a lender. At BOQ Specialist, and I'll probably go through in a bit more detail in further slides as well, we can look to lend you up to 100%, but we don't charge lender's mortgage insurance for any LVR, that's loan to value ratio. And what the structure and all that sort of stuff depends on, again, personal circumstances. We can go through in a bit more detail individually as well, but be sure, and especially in your profession, being in medical field, if anyone is charging you or advise you for lender's mortgage insurance, be sure to look for other options as well, because there will be quite a few that won't be charging you guys LMI. In terms of deposit, there are some government incentives available as well, and the guys from One Group will probably touch on that in a bit more detail, but just to briefly touch on the 3 main ones. So you've got stamp duty exemption or concessions in most states. So if you purchase a property, and if you're a first home buyer, if you purchase under a certain amount, so for example in Victoria up to 600,000, if that's the purchase price or property value, you won't be charged any stamp duty. If you purchase for in a certain range, so for example again in Victoria, if you're purchasing between 600,000 to 750, you'll probably get a discount on the stamp duty as well, and so on and so forth. I believe most states and territories will have some sort of arrangement in place for first home buyers, and we will be sharing a document as well which will detail that for you. First homeowners grants, that's basically if you're purchasing a brand new property or newly converted property. So if something was a warehouse or used for a different purpose before and now it's converted to residential property, you might be eligible for first homeowners grants. And home builder scheme, that's a new one that's been introduced recently during the pandemic to assist people who are constructing or building their new home. And that's also available, I believe, in most states and territories. Another incentive or another scheme, I suppose, this one's from the federal government, so this is the same for most people across the country, it's not state specific, is the First Home Super Saver Scheme. So I won't get into too much detail about this. If you have any questions, you can contact us directly as well. We'll have a Q&A session after. But just to briefly touch on it, what it basically means is that it allows you to make contributions into your super fund pre-tax, and you can take that and you can do that up to a maximum of $15,000 per year. You basically just need to contact your employer and say, obviously they'll be expected to make a mandatory super contribution, and you can say you want to have X amount on top of that to go towards a super fund as voluntary contribution. That voluntary contribution have a different tax rate, so it's taxed at a discounted rate, I believe 15%. So you can save that amount in your super, let it build up, and then you can take it out in a lump sum up to a maximum of $30,000 to assist with the deposit. When you take amount back out as well of super, I believe you can do that online now through ATO. That is taxed as well, but you do get certain tax concessions. So the way it would work, I'll probably go through these bullet points. Why bother saving in your super fund? The main difference is you are getting taxed putting money into the super and also taking it back out. But the difference between the tax rates allows you to save more than if you were to take a post-tax amount from your income, put it in a savings account, especially in the current environment where there's the saving rates, or on most saving accounts, are not great, or the interest rates, I should say. There are different calculators that you can Google as well of how much it would be if you were to take a post-tax amount and put it in a savings account at 2 or 2.5% interest rate, compared to if you were to have the same amount contributed towards your super and take it out in a couple of years' time to fund the deposit as well. Do I need a separate super account? No, you don't. It's just the same super account, but you have to notify your employer that these are separate voluntary contributions and not part of your mandatory contributions. You can't. There's also another misconception that you can access your super, the mandatory 9.5%, I believe, to assist with the purchase. I know there's talk about you've been able to access that during the pandemic for other reasons, but you can't for the purpose of that deposit or for purchase of first home. It has to be the additional repayments that you made on top of the mandatory contributions from your employer. And that covers the point 4 and 5 I'll touch briefly on as well, the different tax rates. Moving on to different property types. Now, this can also impact how much you can borrow from a bank, or how much a bank will be able to lend out for a certain property. So the first one on there, property size. If you're looking to purchase something that's less than 40 square meters, so maybe a studio apartment or student accommodation, most banks will not lend a high LVR for that, and by high I mean 80 or 90 or over. There will be some caps on how much the banks can lend out and how much is required, expectation of how much is required from your end as well. Between 40 and 50 square meters, it generally depends on the property, and over 50 square meters, it's pretty okay for most banks to lend up to 90, or for us to lend up to 90%. Some will still lend up to 80%. So make sure, even if you have a pre-approval, that you keep your bankers informed. If you found a property, if you're interested in a property, let them know, share the address, and they can let you know if there are any restrictions related to that particular property. High density. So high density in most cities would basically just be CBD or surrounding suburbs. So in Victoria, for example, you've got the CBD, you've got Dockland, South Yarra, similar in New South Wales and other states as well. There are also restrictions in those areas of how much a bank will lend out. Again, it's slightly less than what it would be in a standard suburb. So again, let your bankers know and see if there are any restrictions on that as well. And same goes for locations. If it is a rural or regional location, that might also impact how much you can borrow. Or there may be other restrictions as well linked to that property. Home loan features. So just briefly on that, the way home loans are designed at BOQ Specialist, so it's designed to be a full feature product. So it's got this full suite of features in there, and you can chop and change how you like compared to your preference or your needs as well. So we call it a banking package, where you have ability, for example, as noted on this slide, so you can have a variable interest rate loan, you can have a fixed interest rate loan, you can actually have a bit of both as well, so you can split your loan both ways, and have multiple or different repayment types on your loan as well. briefly to go through each one of them, variable interest rate obviously varies with trends in the market. A positive of variable interest rate is that it allows you to have what we call an offset account, and it's 100% offset account. And I think I've got a slide after this one on what that is, so I'll go into detail on that. Fixed interest rate, you can't have an offset account with fixed interest rate at most banks in Australia. You are locked in as well. So if you're looking to fix an interest rate, be sure that you're not going to be maybe selling the property or refinancing the property within that fixed rate term. But your bankers, again, will go through in detail with that as well when they present all the options to you of what our variable and fixed interest rates are. But this is just to highlight that all of them are available. Repayment types, again, you've got principal and interest repayment type and also interest only. It depends on what you're looking to purchase. Most people looking to purchase the first home as their owner occupied or as a home basically would opt for maybe principal and interest repayments because you would want to be paying your loan down over time. It's your personal debt. Compared to if you're looking to purchase the first property as an investment, you might want to keep it as interest-only repayments for any tax incentives. Again, your accountant obviously would be better poised to maybe go into a bit more detail with that as well, or you can ask us and the guys in one group if you have any particular questions around that on how to structure it as well, and we can assist you through that. Offset account, so as previously mentioned, that's one of the features available with a variable interest rate loan. It's a pretty cool feature. The way an offset account works, it's a transaction. It's on the face of it, it's just like a transaction account, but on the back end, it's linked to your variable rate home loan. So any amount that you put in that transaction account or in that offset account, you save on interest on the equivalent amount on your home loan. So the way it basically works, as an example here for say $200,000 loan. So if you've got a $200,000 variable rate loan and you've got no funds available in your offset account, you'll be paying interest on the full 200,000. Now, if you put, say, for example, 30,000 of your own cash into that offset account, which by the way, you can withdraw any time because it's just like any other transaction account. So if you say put 30,000 into that offset account, what the system does is instead of charging you interest on 200,000, it starts charging you interest on the difference, which is 170,000 in this example. So in other words, it assumes that you paid that 30,000 into the loan, whereas in fact, you basically just put it in your offset account and you have access to it and you can withdraw it back anytime. So it's a pretty cool feature. For the sake of understanding, if you've got a $200,000 loan and you put 200,000 in an offset account, you won't be paying any interest on that loan at all, whilst that loan, we call it being fully offset. So whilst that loan is fully offset. And that's again a feature that comes standard with all BOQS variable rate home loans in the banking package. To finish it off on the finance side of it, so why bank with a specialist? There's heaps of banks out there, each one of them offering different products, different features. Why we recommend you go through a specialist, doesn't have to be a BOQ specialist, could be anyone who specialises in the industry, so they understand what you do. We only deal with the medical space as well, and we've been doing it for quite a long time, so we understand the cycle, we understand how you guys operate, we understand your income structure as well. For first home buyers, where that makes a difference is mainly around, or one of the differences is the 100% LVR loan, which I don't think most of the lenders are doing at the moment, without charging any lender's mortgage insurance, because we understand your cycle, we understand where your income and your trajectory as well. And that's only available to our dental, veterinary and medical clients as well. And it's also the way we structure the loans for you as well to assist you as you move through different stages in your career as well. So there's obviously myriad of other reasons as well. There's private banking service that we offer to all our clients, and we can go through in a bit more detail how banking with a specialist can make a difference for you individually compared to if you were to go to a lender that's for, say, everyone else as well. And I believe that's it from my end. I'll pass it on to Julian to go through just a few trends in the property market and whether it's a good time to buy now.
Zain, thank you. Terrific presentation and yeah, beautiful segue. I think when you listen to Zain speak, he obviously does it very eloquently, but you can see the complexity around lending. And I mean, I've probably sat in on hundreds of these presentations, but you just learn something every time. So I guess first of all, thanks to BOQS for putting on such a great event. I know they're very passionate about educating doctors, and we're very much the same at One Group. And I guess well done to everyone for showing up in their personal time, to educate themselves. And no doubt everyone's had a very big day out there. So going to shed some light here on what we're seeing out there in the property market. I guess just to give you some background on us, we're a real estate advisory firm, which means we're not a sales business. We don't have any properties to talk about. We're purely talking about insight and strategy. We exclusively deal in the healthcare space, so our clients are also doctors. In some cases, we're buying sites for medical practice. In other cases, we're buying homes and investment properties. But I guess the universal thing is it's all around diligent investing and informed investing, and that's really what today's session's about from our perspective. Where do you take your direction from? I mean, it's such a shifting landscape, even in a normal world, pre-COVID, the property market and the media obviously take up a lot of their headlines with real estate investment and the movement in the property market. And I think it becomes a bit of an emotional seesaw if this is where you take your direction, your motivation from. And you can see these two articles are only weeks apart, giving very different headlines on the landscape of the property market. And look, it's really been an interesting time since March. And I think if we're going to really explore this in a little bit more detail, and this is just really to set the scene for the opportunity that's presenting out there at the moment for property investors, but especially first home buyers. This blue graph here, and I definitely will make sure we won't put you to sleep with graphs and data, but this initial blue line here actually shows you the recovery that we were going through at the end of last year. So we'd had a property market that had been pretty sketchy for the last 4 years. We had peaks and troughs, and the peak of the market was really back in 2017 over the last 5 years. But what we saw at the end of last year was the biggest rally we'd seen in history. It was almost stronger than the rally we saw back after the 80s recession. And then COVID basically put a double brick wall in front of that and stopped it square in its tracks. So it's important to note that there was a serious amount of pent-up demand out there. So when you then combine that with the 240 billion of stimulus that's been pumped into the property market, and you then combine that with the stimulus for first home buyers and the stamp duty exemptions, and the fact that a lot of people are at home not spending any of their typically discretionary spend, especially in Victoria when there isn't many options, people have got more money in their pockets. They've got more stimulus floating around, and they've also got the ability to get out there and buy property. So from that point of view, the market's been extremely resilient. But when you start to look at the fact that immigration's expected to be down, Treasury stated 56% over the next 12 months, a lot of your competition is not going to be around. So from that point of view, it is a really good time to buy for a number of reasons. So if it's personally suitable for you and financially it's a good time, I think the landscape is really going to present some fantastic opportunities for first home buyers. And one of the reasons we're so obsessed with property is it's probably the investment class and also the asset that we live in that we feel most comfortable with when you look at the different strategies that are available to Australians. And I think we also have more of an obsession than most countries because we've got such a resilient property market and it's served the community quite well. If you're investing for the long term, it's generally been very difficult to lose money. And in most cases, people are profitable. And when you're looking at what's called loss-making sales, which is a number of transactions that go through at a loss, when buying houses, it's almost less than 5%. So you've got more than 9 out of 10 people that buy a house and sell a house are generally doing it at a profitable transaction. So the consistency of it is really powerful. I mean, most of us have got aspirations to live in a big, beautiful home at some point in our lives, and it is really a momentum game, property. It doesn't work in most cases to save up a 20% deposit on a $3 million property. Most people won't have the ability to do so. Their lifestyle tends to increase with their income, and as a result of that, they see property as almost forced savings. The ability to buy an asset that they could potentially manufacture gains on. So perhaps it's a new kitchen, new bathroom, the ability to live in that property for a number of years until you outgrow it. And you have the combination of debt reduction, capital growth, manufacturing gains. Those three things combined give you the opportunity to either leverage out of that property and look at taking the equity and buying another property or potentially selling it off. And if it's an owner-occupied property, lived in for more than 12 months, it's capital gains exempt for the first 6 years that you then convert it to a rental property. So there's also some other ways you can use strategies to accelerate your wealth in property as well. We'll touch on a bit more of those a little bit later as well. We have many discussions with first home buyers, and they're always interesting because the toughest thing you need to do is compromise. And I think once you've gone through the process a few times, you generally understand that that's the nature of the beast. But at the start, it's always difficult to work out exactly what you're happy to give up and what your priorities are. And then you combine it with a bit of agent pressure, a bit of market speculation, a bit of peer pressure, and then all of a sudden it becomes a bit of an overwhelming process. So a couple of key things you really want to reiterate is it's really about getting the right team around you and make sure you're getting advice from the right people. You can see the complexities around the lending landscape, and let's be honest, it might be different again in a month's time. So you almost need to tune into these webinars on a regular basis to see exactly what's going, or just reach out to your banking specialist. It's almost the same in the property landscape too. You get a lot of local agents that'll give you wide sweeping statements on where the property market's at, when really they're only selling property in 1 or 2 postcodes. So where we take our information from is really, really important. Property is very expensive to get in and out of. So we do see some people that say, look, I just want to buy for a couple of years and then move. If you're thinking of holding only for 2 or 3 years, it's probably not the right investment strategy for you. And in most cases, you might be best to continue to save and rent, or considering a rent vesting approach, where you would continue to rent in an area you want to live and then invest in an area that's going to give you superior returns over the long term. It's really important to do your homework on the suburb you're looking to buy in, and also do some homework in the secondary suburbs. The suburbs that might not be perfect, but could potentially provide a superior property style for you. Larger piece of land, or potentially a better location within that suburb as well. Map out your priorities before you get online, before you start speaking to agents. Otherwise, you can get swept up in the fear of missing out. All of a sudden, a property that isn't quite right is potentially going to sell. Next minute, you get some interest because agents are very good at pulling on the emotional levers that we have, turning us into puppets. And make sure you don't compromise on what matters most. Transacting on property, buying and selling is it really chews up a lot of your gains as well. And I think the key thing to remember too is the landscape shifted a lot since a lot of our, the older generations have invested in property, and it's very much a marketplace where areas like Geelong, Bendigo, Ballarat are really humming on the back of a lot of urbanisation, smaller towns moving into bigger towns, and also people looking for sea change and tree change. So the landscape's different to what it was 20, 30 years ago. So any family, friends or contacts that invested a while ago may be looking at the market through a very different lens. Negotiations is a tricky one. I mean, we do it as a profession and we still find it to be a frustrating and often confrontational type process to go through. But I think the key thing to keep in mind is there's generally going to be 2 different approaches from a sale perspective. You're either going to have the private sale or the auction environment. I think the key things to keep in mind here is an auction is an unconditional environment. So you need to make sure you do all your homework before you attend an auction. The first thing would be finance approval, without doubt. Second would be building inspection. I just see it as non-negotiable for any of our clients. If you're going after a property and it's a $400, $500, $600, $700 million investment, spending $400 to $500 on a building inspection is just part of the process. Definitely factor into your budget at least 3 or 4 building inspections so that you don't feel that a $500 building inspection is an obligation to purchase. We have seen people go above and beyond, not our clients, of course, on auction day, just because they spent the building inspection. They thought they really wanted to get the property because of such a small investment. Private sales is generally a different approach. There'll be an advertised price or a range, or there could be an expression of interest closing date. There is some cases where with an expression of interest, you can put in multiple offers, which means you might put in a lowball price with a quick settlement, or you might put in there a higher price with a longer settlement if that was something that would be favourable to you. So the key thing is I think it's always good to get an independent pricing assessment on the property. We are seeing cases where agents will price a property too high, 550, but then they'll tell buyers coming through that it's a deal at 500 if they put in an unconditional offer. And we look at it and say, well, it's really worth 460, 470. So there's quite a few tactics there they'll use to get you excited and think you're getting a deal, said invertedly. It's really important to find out the vendor situation. I mean, if you can understand why they're selling, you can generally work out whether they're going to want a quick settlement, early release of the deposit, or whether they want to rent it back. We just had a situation where an older clientele wanted to sell the property, but in this climate, stock level is very low, and they're actually keen to rent it back from us, which means the other 2 parties that were interested, who are owner-occupiers, we could take them out by paying less than them, but giving them a rent-back option for 6 months until they found another property. So for a lot of first-time buyers, that wouldn't work because you need to be moving into the property inside 6 months, but it definitely could work for a 1 or 2 or 3 month period in a landscape where most people are looking to sell before they buy because of the uncertainty. Unconditional offers are really powerful as well. A lot of times in this climate, you're able to secure properties with a lower buying price than your competitors if you've got an unconditional offer. So instead of putting it in subject to building inspection or conditional finance, get the building inspection done, speak to BOQS, make sure you've got conditional approval, and go in there with confidence as well. And if you're really wanting to do all your homework, then get an independent pricing assessment as well. Auctions are a tricky landscape. I mean, if you don't get a bit of butterflies in your stomach when an auction's about to kick off, I don't think you're human. So don't be worried about that, and just wiggle your toes and brush off the nervous energy. But the key thing is to get to a few of them. Just watch the process, learn how they're executed on the day. And I'd also say, don't take people's witchcraft techniques around never make the first bid. I think sometimes it's good to brush off the nerves and put in an early bid. I don't see anything wrong with that. And there's no statistics around the first bidder never gets the property. The other thing to remember too is the auctioneer is generally quite amped up and excited. So they tend to be a little bit aggressive. But if you're polite to them, and if they're pushing you for a $20,000 bid and you only want to put a $5,000 bid in, you can control the bidding. And that's probably the biggest lesson I think to pass on to any novice buyers is you can control the auction and you can control the bids. If they're asking you for 20,000, you only want to put forward 5, just apologize and say, I haven't got the 20, but I'll give you 5. So you can really take control of that environment and just make sure you do it in the right way, because otherwise they can get a little bit upset. And the key thing is stand up the front where you can see everyone. I think it's always harder if you hide away and you can't read the faces and read the body language of the people that you're bidding against. First-time buyer incentives really do differ from state to state, but I guess just to touch on the general theme of this, and we will be sending out a resource for everyone on the back of tonight's presentation. There'll be 2 resources. There'll be an inspection checklist and a property buying checklist put together by BOQ and One Group, and also there'll be a list of the different concessions and grants and stimuluses that are available to you as a first-time buyer across each state. Generally speaking, the stamp duty exemption that Zain touched on is sub 600 in Melbourne and I think sub 700 up in New South. And there is also some additional first home buyer grants for new property, and they do change. For example, in Victoria, non-regional versus regional, so 10,000 in non-regional and 20 in regional. So there's been some pretty amazing situations where people have gone and taken money out of their super because of the ability to do that during COVID. They've then tapped into the first home loan deposit scheme, which is no mortgage insurance with a government-backed loan. There is an application process for that, which is generally not required for healthcare because obviously you're able to get that, as Zain touched on before. And then also you've been able to tap into the home builder grant, and then they've also tapped into the first home buyer grant. So the grants have been phenomenal from that perspective. So some people, and I just touch on this to talk about where some of the propping up of the property market's been. It's all about, it's just saying that some people have gone from having no money in the bank to taking money from super, tapping into stimulus, using first home buyer grants, and they've been able to get into the property market potentially years before they were really going to be able to. It is income tested as well, some of these schemes, and the home builder grant is also available for renovations. So interestingly, you can renovate your house for up to 150,000, and there is a 25K stimulus that's available for that as well. Key last point there to touch on was if you are tapping into any of those stimulus packages or initiatives, I should say, then you do need to be moving into the property. It does need to be occupied within that first 6 months. So which property style to invest in is always, it's always an interesting discussion. It really comes down to land size, location, lifestyle, and budget, I'd have to say. I mean, this is the blend that most people are needing to find, the perfect formula on. I mean, the obvious advantage of houses is they generally have the highest capital growth. They generally have the greater chance to manufacture gains, turn a 2-bedroom into a 3-bedroom house, or add an additional bathroom, or look at an extension. So in most cases, houses are going to give you the greatest upside. They generally have the most maintenance and the most considerations around any potential costs that could be unforeseen. For example, older houses, plumbing issues, or electrical problems. Whereas you generally have those things taken care of if it's in a body corporate or if it's in an older structure. If you look at houses in Middle Ring, the supply of them is being reduced significantly. So to build a townhouse or 3 townhouses, which is common on a house site, you need to knock over a house. So they're diminishing the supply of houses and they're increasing the supply of townhouses and apartments. So in most cases, houses tend to be the better investment because at the end of the day, supply and demand is what drives the property market. And if they're reducing the supply of houses and increasing townhouses, is going to be a better investment metric. With townhouses, it tends to be a compromise where someone doesn't want the house that needs to be renovated. They prefer a newer property, or they prefer to be closer to the high street or closer to the transport. And that's generally where it's zoned for townhouse development. So when you look at the planning schemes in most capital cities, they tend to zone around infrastructure hubs and train stations for medium density, which is what a townhouse development would be. So key things to look out for. I mean, if you can secure a townhouse that is single level, there is real scarcity around that. And when we've got an aging population and we've got a scarcity of these single level dwellings, it does create a great investment strategy as well. The key thing is to be mindful of the building fabrication. Like in the apartment space, there's been a lot of cheaper fabrications that have come out in the last probably 5 to 15 years. And although there's some more stringent governance around them now, there was a period where there was some unethical and probably some uneducated building methods being used. And unfortunately, they've created some very substandard quality townhouses as well. Reverse living, which is mentioned there, is when there would be bedrooms on the ground floor and then the living space and kitchen space is on the second floor, which is very common because in most planning schemes, to have a living space on the second floor means you don't need to have a big courtyard, and therefore you can fit more townhouses on the block. Now, in some cases, if you're near parks or water, having the living elevated can actually be quite advantageous, but it does mean it's a bit darker on the ground floor where the bedrooms are and you don't have a ground level outdoor space. So we're seeing a lot more supply with reverse living. Apartments, you've got to take the absolute duty of care with apartments and really do your homework. Key things to keep a lookout for is what's in the sinking fund, which is essentially a savings account for the building for any maintenance. So depending on the size of the building, there should be anything from $100 to $1 million in that fund. Obviously, the bigger buildings need the bigger kitties in case there's any issues. Fixing, things like your plumbing in a house might cost you 10 grand. In a big building, it could cost you, north of $500,000. So key thing is you want to make sure there's an annual contribution to the sinking fund and also make sure there isn't any outstanding matters. I guess you look at the body corporate minutes as almost the minutes of the building, which is a business, and you want to see how functional it is. Is there, a dysfunctional ownership group, or is everyone being listened to and are the problems being dealt with? Supply is probably the nemesis of apartments. The more apartments are getting built, the more issues you might have with off-the-plan valuations. When you're buying an off-the-plan property, you're buying it at today's prices, even though it's really not settling for potentially 12, 18 or 24 months. So there is definitely some risk there that the contract price is not what it's worth in 12 or 18 months, and you would need to foot the difference in that contract. So there is a lot of risk around off-the-plan and apartments. And I think in this climate too, you have a lot of developers that are doing deals, which would be selling properties that perhaps other people can't settle because they've lost their job and they can't get finance, and they take 10 or 15 or 20 grand off the contract and they create a bit of hype around that. The problem you have is it might be worth even less than that again. So just be really careful if you're navigating that new property space. It can be a bit of a slippery slope. We prefer, if you're going after apartments, the least amount of amenities and services and shared communal areas, the better, because the body corporate fees will be less. Smaller buildings of 4 to 20 generally, and obviously as much land content as possible. With the planning schemes on most of these quiet side streets that are tree-lined streets with low-rise apartment buildings, they're not really zoned appropriately to do those kind of developments anymore. Most developments need to be in busy locations and near busy landmarks like train stations and high streets. So when you get into these quiet tree-lined streets, they actually can't replicate those buildings anymore. So in a lot of cases, there's a real scarcity around those types of properties. As I touched on, there's quite a few properties that are at high risk, and I think I've touched on most of these. The only thing I want to point out here on this graph is this is the increase in property listings in a city in Sydney and Melbourne in March to end of April. So they jumped about 40%, and they're actually now up 100%. So that's the number of listings online without a tenant. So there's definitely going to be some hurt in that space, and if that's your strategy, it is going to be easy buying for those types of properties. To touch on the first home buyer strategies that we see the most would generally be the rent vesting approach. I think most first home buyers tend to have that dilemma of, do they continue to live the lifestyle they enjoy in a property that perhaps they can't afford? I mean, depending on your capital city, it can be quite a cheap alternative to putting $1 or $1.5 million into the property market would be to rent that style of property. But it tends to be a strategy you need to commit to over the long run. So it doesn't work generally to rent vest for 3 years, sell the property, and then take the equity to the next asset. In most cases, if you're buying a property, you need to be holding it for a minimum 5, but in most cases 10 plus years. So you might deploy the strategy Zain mentioned, where you go in at a 90% land and you park all your additional savings in the offset account, and you continue to build another deposit for the next property, but also reducing your cash flow, your interest payments on the property you already hold. So these are the strategies you want to talk to your accountant about. You want to talk to your finance professional about as well. And if you've got a buyer's advocate, I mean, it'd be good to get them involved in the discussion, because they can give you some more market alternatives around that as well. The 6-year rule would be where you might live in the property for 12, 18 months and then move out and rent it out for up to 6 years and turn it into an investment property. So therefore you get the benefits of buying as an owner-occupier, but then you also get the benefits of it being an investment, and you can sell that without any capital gains at the end of that, if your accountant approves that, of course. And that allows you to take a bigger chunk of money to your next property as well. Most of the others there we've really touched on. I think the key thing is with property, it's really got to be quality over quantity. And we do see a lot of doctors who naturally over time get very, very high borrowing capacities. And everyone needs debt to get into property and to expand their portfolio, and debt's readily available to doctors. And they have a real edge in the market because of that. And they also have an edge with the resilience of their employment. But that can sometimes give a sense of complacency around property due diligence. So do be really careful what you invest in, and make sure that if the market fell apart next year, you'd still be very happy with the decision you made on the property. And if you had to hold it for 10 years, you wouldn't lose a night's sleep on the back of that decision. Everyone wants to know where the market's headed now, based on stimulus starting to taper and immigration also starting to waver. I mean, the key things that we want to talk to is trends more than anything else. I mean, these are the trends that we see really hanging around regardless of what happens with the wider property market and with stimulus. A lot more people are considering more dynamic working environments. They're considering whether they can move away from busier cities, and that's going to create opportunity for other people to move in to some key land holdings. I think more than ever, the quality of our suburb is under the microscope. And even though public transport's out of favour now, it's more important to the planning schemes within councils. So they're always going to build up lifestyle hubs around transport. Most of the others I've touched on, so I know we're trying to wrap up and get some Q&A happening, so I might leave it there and throw it back to Alex and Zain so we can get some questions that are more relevant to the audience happening.
Perfect. Thanks so much to Zain and Julian and Tal. I'll just stop this slideshow here so we can launch into some Q&A. So we do have a few questions that have come through from a few of the people viewing. So let me see here. So the first one I might hit Zain up. This is one that we often do get asked, so it is a very good question. Does applying for a pre-approval affect our credit rating?
Yes and no. So I mean, we use Equifax, which I believe most banks would use as well to access your credit score. Their algorithm, I suppose banks won't know how they calculate your credit score. There's a bit of a guide online if you go on their website. Does it impact your credit score? It will, but doesn't necessarily mean it'll negatively impact it. Debt, like for example, just to give you an idea, if you apply for 3 or 4 credit cards or personal loans, that might impact your credit score in a negative way, more so than applying for a secured loan like a home loan. We're also moving towards kind of like an American way of doing things, a positive credit rating, which means if you do apply for a home loan and you're making repayments on time, that actually might improve your credit score. So applying and having a home loan is probably a good thing rather than having a negative impact on your score. So to answer your question, I mean, how it impacts probably is correct. Rating agents can probably answer that a bit more. But if you're applying for, most people, just to let you know, will apply for 1 or 2 pre-approvals. If you're applying for 4, 5, 6, and that's a different story. But 1 or 2, quite common, and won't have too much of a negative impact.
Perfect. Thanks, Zain. So I have another question here that I might ask to either Julian or Tal, whoever wants to jump in. With a potential downturn in property prices with current condition, what types of property would you expect to have the greatest drop? Like apartments versus houses, inner cities versus growth areas, etc.
I feel like I stole the presentation, Tal, so you're more than welcome to jump in on that one. Oh, your audio.
Your audio is
on. Maybe I'll jump in then. That might be a bit easier. Yeah, so the market's going to become very fragmented, and we're seeing that now with the data. I mean, I was looking at St Kilda the other day, and it was showing 60-something% growth in houses, and I thought, hang on, something's not right here. So we look into it, and there'd actually been 2 $5 million transactions that had gone through, and it had skewed the data on the area, the median house prices. So you're also going to see that the other way. You see a lot of properties on busy roads or substandard properties in certain suburbs sell, and then that can push down the median price in that area. But it's because a lot of B-grade properties transact in these times, but not a lot of A-grade properties hit the market. So every area is going to have some impact, but it's going to become very fragmented. And if you look at the question that's been asked, without doubt, new property. I mean, high rises and also house and land packages, because what's happened here with this build stimulus is it's been fantastic for creating jobs and getting builders busy. But the problem is you've had land values in house and land estates rising at the developer's discretion because people have been trying to get in on this grant when the wider property market's been flat or dropping. So you've seen people that are trying to buy in estates miss out and then pay another 15 or 20 grand on the next release, but the wider property market is not growing like that. So you've got this disparity between what people are paying for new property with what the wider market's doing. So I think where areas of low owner occupiers and high level of investors are a problem. New property developments are a problem, and then house and land belts are also a problem in certain areas.
Yeah, definitely agree with that, with the new properties as well. We've seen a few of those. Okay, another one for Zain. For medical professionals, is there any favourable interest rate if we front a 20% deposit as opposed to a 10% deposit, given LMI is likely to be waived anywhere?
Yeah, so no LMI for 80 or 90, but yeah, that is the difference. So most banks will have categories that'll start, generally I think there's broadly about 3. So loans with LVR of 60% or lower, and then 60% to 80% will be a different interest rate category, and then 80 to 90 will be different still. So different interest rate categories as well. We don't have a black and white rule to say, hey, if you're at 82%, you're going to fit into that higher category. So we can negotiate that as well. Interest rate's always going to be negotiable. So there are categories, but we can work through that with you as well. In some cases, for example, especially for first home buyers, BOQ Specialist is quite, like interest rate will be quite attractive. And just because you are purchasing a first home, it'll be a first home loan obviously as well. So yes, there are differences, but again, always negotiable.
Perfect. Okay, I've got another one here with regards, so this will be for Julian or Tal, if you've got your sound working. With regards to one group, if we were hoping to look for a principal place of residence with a view to change to an investment property in the long term as a first home buyer, are they able to give an approximate cost to have a buyer's agent? Yeah,
I mean, happy to give that info, but I guess also just to give some insight into the buyer's agent space, because I think it's really important that everyone knows, there's other options out there. And if you do speak to a buyer's agent, it's important you look at whether they're a fixed fee model or they're a percentage-based model. So some will charge like a sales agent, and they'll have either a percentage of the value of the property that they'll charge you on acquisition, and they'll charge it as a success fee. And the problem you can have then is they then have a highly vested interest in you buying quickly. So sometimes there can be duty of care that falls away on the back of that, not always, but sometimes. The other method is a fixed fee, and fixed fees where they quote a fee up front and they say this is what the fee is going to be, whether you spend $600 or $1 million, it's the same fee. And that's what we do. We charge a fixed fee. We see the transparency around that. There's also an advisory piece sometimes. So a client might say, look, I don't know where to buy. And then there needs to be some research done around where they're going to get the best return on investment with that money, and whether they deploy the money into a regional catchment or whether they deploy it into an inner city unit, which is a smaller building and they're going to renovate it, or are they looking at buying something freestanding in an ideal suburb? There's so many ways to go about it, especially if they're rent vesting. So I think the key thing to remember is everyone's going to have a different model. In our model, the fee ranges could be anything from 10,000 up to to 20. That's probably a broad way of saying if it's very hands off and very directed into a certain region, there's not a lot of advisory work done. It's more of the grunt work of searching, inspecting, pricing, negotiating. It could be around that 10 to 15,000, which might be a 2 to 3K engagement fee and the rest on successful acquisition, which is when any agent's going to have the best impact for you on price with their negotiation skills. And then, I think on the percentage side, they generally range between 2 and 3%, depending on the value of the property. Yeah.
Oh, interesting. Cool. So we've got a few questions coming in. I'm not sure if we will have time to get to all of them, but we will definitely try and get some information out to all of you after the presentations on all the questions that you have asked. But I've got another one here that we do often get asked as well, so I'll ask this one to you, Zain. If you were to buy a principal place of residence and rent a room out, does that count as owner-occupied or investment property from a bank's perspective?
Again, each situation is going to be a bit different, but in a standard setting where you are looking to purchase as owner-occupied, yes, that would, I think the way that question's asked for, yes, it will be classed as owner-occupied. And if you're looking to do rent out a room, say, or maybe convert to Airbnb or just sublet it out, that's perfectly fine. And that's going to be a conversation they might have with your accountant as well of how they want to maybe apply any tax deductibility to that or negative gearing to that as well. From our point of view, a property can only be classed as one or the other. So it will be, depending on the situation, most likely owner-occupied. Perfect.
We might have time for one more, and then we'll wrap it up for this evening. This is I think an interesting question to wrap it up. So again, I'll aim it at actually anyone, whoever wants to look at answering. But are you expecting a further downturn in property prices with the withdrawal of current economic stimuli, for example, JobKeeper?
Zain?
Very.
I'm only kidding. I think. Yeah, look, it's a great question. I mean, I think it's on the tip of everyone's tongue at the moment. I mean, you have to look. For example, I'm in Victoria, and we look to Sydney and Brisbane, how they've recovered. I mean, those markets are growing at the moment. They're not going away. And keep in mind here, we say that they're growing, but there's still fragmented sections which are really struggling. But generally speaking, the market's got good appetite for quality assets. And I think what we're expecting to see early next year is much of the same, really low transaction levels. I mean, debt's incredibly cheap. Holding a property is cheaper than renting in most cases. It seems to be that the banks are happy to apply some flexibility to the fact that if you're a pilot and you're not back flying, you're probably still going to have some level of debt freeze on your assets. So I think there's a lot of flexibility in the stimulus and in the support that's out there. And if that remains, which is expected, based on the presentations that we've seen from from those in the know, then I would expect that the government's going to do everything they can to make sure that doesn't happen. Is that guaranteed? No, definitely not. And does uncertainty make buying anxious? Make you anxious? 100%. And the best opportunity always presents in an uncertain environment. And we're not saying that you need to go out there and act like vampires and capitalize on someone's negativity, but there is situations where people need to buy and they need to buy quick. And if you can find those and you can get the deal done at a great level, that doesn't mean that the market's at that level. That just means you've done a great job. And that's the key thing at the moment. I think not everyone is buying at exceptional prices, but there is opportunity to buy at exceptional prices. But I think the masses will probably keep paying, market rate, which is pretty similar to where we are at the moment.
Yeah. Awesome. Well, thank you so much to everyone who joined us tonight. Thanks for taking time out of your evenings. I hope you did find something useful and informative out of tonight's session. We will send through all the information that we've chatted through, and we'll try to get back to all of you on your questions as well. But thanks so much to Julian and Tal and Zain for all taking the time out of their nights as well, for coming along. And yeah, we will see you all soon.
Thank you.
Thanks, everyone.